Okay, now let's talk about there's three basic transactions that we deal with really repetitively right now. The first one I'll mention is the trustee sale buyer. So
Yes.
the Norris Group goes to the courthouse steps, we buy properties at trustee sales, and
Right.
there's 30 other people standing there
Right.
doing the same thing. Well, that's an all-cash transaction. So that buyer's
Yes.
bought it for cash, and we now have them coming to us saying, we need some of our money back so we can continue to do this. So what basically is the amount of money they're going to end up with? Let's say they've bought something for $400,000, or maybe that's too much, $300,000 at the trustee sale.
Right.
What will we end up loaning on that property, let's say?
Typically on that, with the trustee sale buyers, we're going to go about 80% of what they pay for it. So
Okay.
that would make our loan about $240,000, and probably will make our loan to value, which we touched on what that was earlier, probably make our loan to value somewhere around 60%,
Okay.
if not a little less.
Okay.
And one thing we found with the trustee sale buyers, speed is very important for them. So that's a group of people that if they don't have money, they're out of business.
Mm-hmm.
So we really work hard to try to get the money reinvest or back to them as quickly as possible.
So it's also a fairly sizable loan. That's probably our biggest trustees at this point, are trustee sale refis, I would say.
Yeah, they tend to buy in a little nicer areas.
Mm-hmm.
They don't need as much work.
That's right.
So they're back on the market quicker. There's a lot of turnover. Those might go 3 to 4 months, where maybe some of the typical rehabs might be 4 to 6.
Right, but they're definitely in a different price range usually than the REOs.
Yes.
And the key point is these people have cash. That's
right.
So we're not inventing the purchase. We're refining the purchase. So
Yeah, and I've had investors ask me on that exact type of transaction, well, like, what's this like, or what are their qualifications? And I kind of just tell them, and I'm not trying to be funny, they just spent $300,000 cash for a piece of property.
Right.
For a company like ours, that's qualifying.
Yeah, and I think that's real important to differentiate. There's a lot of practical decision making that goes on in a hard money loan business.
Right.
Because we'll look at a FICO score that's, say, 650 much differently if there's $300,000 in somehow in a credit line availability in cash. Now
Exactly.
that person may have to have a bigger down payment. We're not going to say no to that.
Right.
That's the problem with standard lending world, is they look at that and say no, but it would make absolutely perfect sense.
Exactly.
Okay.
Exactly, and it's quite common because you do have a lot of people that had properties that either did modifications or had to let a few properties go, and one of the reasons they did that was that so they could save their cash.
Right.
They made a conscious decision to let a few properties go so they could still be in business.
And go on.
Yes.
Yeah. Another very common transaction is a lender-owned property purchase.
Yes.
To where this person is going to buy and then fix and resell this property. So let's go through that typical transaction. Let's say it's a $150,000 purchase price.
Right.
So give us an idea of what the appraisal probably ends up being, and then the loan.
Yeah, if that's a $150,000 purchase price, the final value might be somewhere in the $250,000 range.
Okay.
The house might need somewhere around $20,000 in repairs. Maybe you have $5,000 in cost, $10,000 in cost, something like that. So typically what we would do is we might do a $150,000 loan.
Okay.
And people are going to think, okay, that's 100%.
Right.
But you have to realize what we're going to do with that. We're going to hold that $20,000 for repairs.
Right.
And then there's $10,000 in cost. So in actuality, they have $120,000 coming from us
Right.
to go toward that purchase. So the
Of
client
150.
already has $30,000 out of their pocket, let's say.
That's right.
Okay, so it's not really 100%.
No, and that 20 that we keep in the kitty isn't released until we have a 250 property.
Yeah, we release that in 2 phases. So they do like half the work on the house. They might get $10,000 back. So at that point, they're actually out $40,000.
Right.
So once again, we're dealing with somebody that has the capability to do that. And then when they finish the house, we go out and inspect, see how they do the work, and then we release the final $10,000.
You brought something up that is important. We do treat people a little differently if their work is
Yeah.
astonishing, actually.
I
Some of
was
them are
actually going to
almost
say that, whether you ask me or not, because that's a good point. One of the things we're able to do is when we go out and see a new client's work, it does help the appraiser know what the next house is going to be worth, because
right.
some people will do, I mean, you've seen it's amazing some of the work people do.
Well,
so they're going to sell at the higher end of the market.
I think one of the reasons why we have those clients is they attend training.
Absolutely.
And they see our houses,
right.
and they go through them and go, okay, this is how it's supposed to be done.
Right.
And so we end up having some of those clients do the same model. Not everybody, and it's not always necessary. Right. But we end up having really good end products that we've done loans on.
I'm constantly amazed at the after pictures. I really am.
Yeah, some of them are unreal. So those, we have trustee sale refis, we have lender owned, and here when we're doing that loan, the second one, we're actually funding into the purchase.
Yeah, there'll always be an escrow open, a purchase escrow, and they'll do all the title work and everything.
Right.
And we'll just kind of tie into their work, and we close it as just like if somebody were to buy their own house. It's the exact same transaction.
Okay. The last loan that's definitely getting more popular and really will be a very, very popular loan coming up is either it's going to be a rental, whether it's
yes.
From the get-go it's a purchase to be a rental, or it's a refi of something they already have.
Yes.
That will be a dominant loan that we'll be doing. Is somebody that has in mind to let this inflate, and most of my profit will come from a sale of it years from now.
Yes.
Okay.
And how we're doing that currently, we're going to have really two ways. One is people are paying cash for it. Mm-hmm. They've already fixed it up, and they've had it since it's a relatively new program for us. There's a lot of people that have these houses that would like to leverage them. So for those people, we're just going to go like approximately 60% of the value, and just fund that, get some of their cash back so they can, as you say, just hold it. And then it will also be available as a purchase program. And what we'll do is we'll go the same 60%, but we'll hold some of the repair money if it's necessary on the property till it's finished. So the investor won't really be at 60% of the value till the house is completely fixed up.
Okay. We mentioned that 19.6% of all the transactions are cash in yes. 2009. And one of the reasons that an investor like myself would buy cash is that's how you get the best deal. It's not that we really wanted to spend all our cash that way, but right. It drives the hardest bargain. Then they walk this over, and a lot of time the purchase price has been so significantly below the market, it'll cash flow. And from experience, they know I should hold some of these this time. And right. So that loan will it's going to get very popular either at the purchase point or the refi point. Right. And that's why it's an opportunity for everyone to buy and hold, and also for the person that's got money at 9% in this market. That's a great return for the risk. Yeah,
it's a gigantic do-over for people that didn't do it the last time we had inflation. Absolutely.
I think that's a great word. It is. What's nice about, we've been through this before, and we know right. California goes through cycles. Now this has been a hard one, but now we're going to be on the gradual mend going forward. As a real estate investor, I know hard money worked for me because it allowed me to expand my business. And putting up money in trust deeds works. You've watched people be very pleased with their results over the years. You yourself invest in trust deeds, as right. do I. And it's just a very safe way to go to get a great yield. I appreciate you taking the time.
Absolutely.
And I'm excited about the future. And I think if you have any further questions about investing in trust deeds, please give us a call at the Norris Group, 951-780-5856. And go to our website, www.thenorrisgroup.com. Thank you.